Well, let's start with this. If Elon gets 25% voting power, Tesla is reincorporated in Texas, and compensation package is approved, then AI and robotics stays within Tesla and the company can march on forward to become the largest company in the world, to which Elon responded, yes. So that was a post that somebody put up yesterday, and then Elon responded yes to it. Electrek and others thought this was a threat on his part. If they called it a possibly implied threat, I'd almost be able to agree. However, it is stated in the affirmative. In order to be a threat, it would need to be formatted in the negative. If I don't get these things, I'm leaving and Tesla won't get those things. But that's not what it said. It basically just said, if those things all happen, no problem. Marching forward doesn't say anything about what's going to happen if those things don't happen. Now, earlier, just to give it a lot more understanding and depth and flavor and nuance, Elon has stated he would be uncomfortable driving towards AGI if he didn't get about 25% of the voting stock. He has stated clearly it's not about the money or even overt power, but rather a defensive power to keep the company from going off the rails in a kind of Lord of the Rings type scenario. The golden ring driving the owners nuts. So this is a far cry from being a threat that he's going to do something horrible if he doesn't get his way. Electrek then also mischaracterizes further. In recent years, it says, Musk has repeatedly stated that Tesla is an AI and robotics company. Absolutely true. He has even said that Tesla is worth virtually nothing without self-driving, its main AI product. They say this to continue their nonsense in this article that somehow there's some kind of Elon is going to hurt the company and hurt the shareholders, and everybody's going to have to, be very sad because things didn't go Elon's way. But I'm sorry. I wish Elon had made that statement a little differently, but he has totally clarified this statement multiple times. And anyone with an ounce of sense can see that this is a hyperbolic statement regarding comparative value. The value proposition for Optimus and Robotaxi is multiple times outsized by any comparison to the other divisions. So therefore, when he says that Tesla is worth virtually nothing, this is a hyperbolic comparison. It's really sad because this nonsense becomes part of the debate over the compensation plan and is either stupid beyond hope or intentionally misleading. How do you see it? Love to see your comments below. Then, I'm not quite sure how to take this article from Washington Post. I'm no fan of the Washington Post, that's for sure, and their ownership, of course, is no fan of Elon's. Here we go. It's talking about charging stations, and it's talking about generally and including Tesla in the story, but I think this is very important. For the past few years, electric vehicles have flooded onto Americans' roads. Tesla's Model 3s, Hyundai's Ioniq 5s, even the occasional electric Hummer. In 2023, automakers sold almost 1.2 million all-electric cars to U.S. consumers, accounting for over 7% of the total new car sales and new national record. But all those cars also need a place to plug in. And while the country is also expanding public charging, data shows that EV sales are outpacing the growth in the U.S. charging network, endangering the transition to electric cars just as it's starting to take off. I think that's nonsense, but we'll keep going here. Between 2016 and 2023, EV registrations in the United States grew almost 3 times faster than the United States public charging infrastructure. In 2016, there were 7 electric cars for each public charging point. Today, there's more than 20 electric cars per charger. Now, let's think about this for a second. 20 electric cars per charger. That would mean that those 20 cars would need to charge every day. I'm sorry, let's assume they charged every single day, took 10 minutes to charge. And so 20 times 10 minutes, 200 minutes, that's 3 hours or something on charging out of the entire day. Well, that doesn't seem like a very good deal but that's right. They're not going to charge every day. In fact, some of them won't charge. I charge like maybe we use the charging stations maybe once every other month. Anyway, you often hear about the chicken and the egg question between chargers and electric vehicles, said Corey Cantor, Senior Associate for Electric Vehicles at Bloomberg, an energy research organization. But overall, the U.S. needs more public charging. It's a pivotal moment for the U.S. charging infrastructure generally. Last month, Elon Musk fired the entire 500-member supercharger team at Tesla, which had helped make the company's network the most reliable and widespread fast charging in the country. The U.S. government has pledged $7.5 billion to build out more fast chargers, but at the end of March, only 7 stations and 38 individual chargers were up and running. Many EV drivers don't require public charging regularly. According to Energy Department, around 80% of EVs are currently powered at home. But as Americans purchase more and more EVs, public chargers will be essential to support long road trips, help apartment dwellers go electric, and alleviate overnight pressure on electricity grids. Around 1/3 of Americans don't have access to a garage or a carport. Expert says there's no magic number for the best ratio of EVs on the road to public chargers. It actually depends on the local landscape, said Peter Slowick, U.S. passenger vehicle lead for the International Council on Clean Transportation. Globally, there's about 1 public charger for every 11 EVs, according to the International Energy Agency. But in countries where there are more single-family homes, like the United States, and garages, the ratio could be lower. In China, where many drivers live in apartment buildings, no kidding, and in multifamily housing, there's approximately 1 charger per 8 electric cars. China has over 1 million public chargers, compared to roughly 168,000 in the United States. In Norway, on the other hand, there's 1 charger for every 34 electric cars. And of course, we know about Norway being almost 100% at this point in terms of new car purchases. Even if there's no ideal number, studies in the U.S. charging landscape have found there should be a public charger for every 10 to 15 electric cars. That's not sustainable for the people making the chargers. It's just not sustainable. Far more than we have right now. The higher the number of EVs per charger, the more likely that drivers face lines or other inconveniences when they try to fill up. And the fact that not all cars use the same charge system, we know about that, Tesla, blah, blah, blah. Just because we have the right number of EVs per charger doesn't mean that everyone can assess them. So the slow charging buildup, the promise to switch to Tesla charging, all of that is going to help. But not everyone agrees with that there's any delay. Slowick says his team's research shows the United States is on track for building out the charging needed over the next 8 years, and increasing the number of EVs per public charger is a natural part of the adoption process, he argues. By the way, they don't even mention the fact that Elon has restated that they will be spending $500 million this year on chargers. Anyway, but others say that if EV sales continue to go without an accompanying increase in chargers, consumers could face long lines. I always come back to the 2 barriers around EV adoption, which are the upfront costs and the charging anxiety. If we're not making these concerns better, then you're not helping. Now, do they realize, of course, that once you have the basic charging structure in place, you don't necessarily have to front run the cars that are coming out. At a certain point, the opportunity for investors, the opportunity for entrepreneurs to get in the business and take advantage of the opportunity becomes clear. That's not true when Elon was starting out 16 years ago. He knew he had to build out the infrastructure because nobody else was going to do it. But that's all changed now. Anyway, and I think it's a big if, Tesla does amazing on charging, they might reach $100 billion in sales. That is a great company, but compared to $400 billion in cars, $400 billion in energy storage, maybe $200 to $400 billion in semis, and then trillions in RoboCab and Optimus, it's a tiny, tiny piece of the Tesla business. Therefore, what really needs to happen that people aren't considering, and you're only going to read it here, there's a huge need for destination charging. Apartments in particular, but hotels, campgrounds, and such. Also large businesses, malls, universities, and government facilities. And we know that Tesla now has partnerships with a lot of these types of companies. But the big missing one to me right now seems to be to target more units in apartments. I think the market will take care of this naturally, but I would like to see a little more proactivity from Tesla. Maybe it's happening and we just know about it. This is Randy Kirk. Have you hit the like button yet? I certainly appreciate it. It helps the channel. And then if you hit that subscribe button, that helps the channel too. And then notify, that means you'll be First in line, you will know about it immediately as soon as Brian White's video comes out tomorrow, as soon as Scott Walter's video comes out on Wednesday, as soon as you know the story. We've got a great lineup here, and you want to know when these folks are going to be on the show. And so that's why you hit notify. Then, if you really want to help the channel, you can join Patreon, and that information is the description below. Okay, Morningstar is reporting this in terms of general news right now, the general economic news. New York City's investment chief and other chief, I'm sorry, this is still on Tesla. Sorry to misreport here. New York City's investment chief and other key investors are urging Tesla shareholders to vote against Chief Executive Elon Musk's $56 billion pay package and the re-election of Kimball Musk and James Murdoch. Musk's pay, voided in Delaware court, does not serve Tesla shareholders, the group said in an open letter Monday. Shareholders should not pretend that the award has any kind of incentivizing effect. It does not, the letter said. What it does have is an excessiveness problem, which has been clearly apparent from the start. I don't think I need to explain this to you, do I? This was stated over and over and over again by everybody in the press. Every single person covering it said that Elon was not going to make this deal, that this was a crazy thing for Elon to have agreed to, and that there was no way he was ever going to make even one of the tranches. So this is such horrible nonsense. Tesla shareholders will vote on the CEO package. The meeting is scheduled. We know that. Signees on Monday's letter included Amalgamated Bank, Danish Pension Fund, Nordea Asset Management, United Church Funds, which is an investment mostly serving United Church of Christ churches and ministries, as well as the New York City Comptroller Brad Lander. Okay, the letter also slammed Tesla's board, saying that its failure to curtail Musk jeopardizes the Tesla brand. Over the past few years, Elon Musk has dominated the headlines with his public fights with regulators, acquisition of Twitter, controversial statements on X, and his legal and personal troubles, the letter said. Oh, what about him helping the world to become a more successful place as a result of Starlink? What about his landing rockets on their rear ends and putting those Starlinks into space, along with making space travel less expensive for everybody? Oh, what about his generosity in providing these Starlink Starlink services in emergency situations? I don't know. I could go on and on about all the. How about Neuralink? Is that? Oh my goodness. There are indications that a steady stream of negative Musk-related press coverage has led to a decline in the company's reputation among consumers, among some crazy, really lefty-wing possibility. Anyway, Tesla suffered from a material governance failure, which requires our urgent attention and action, critical to reject Kimball Musk, who is Elon Musk's brother, and James Murdoch's re-election, given no reason for why they don't want James Murdoch anymore. Yeah, so now you know why it's important to vote your shares. Now you know why every vote counts. Please don't fail. All right, CNBC, please keep your eye peeled on this issue. This is the big issue in terms of the economy. This is the big issue in terms of the stock market. Remember, I told you first. Remember that when the time comes. Like I told you, there'd be no recession last year. Like I told you, the stock was going to go to 300 and hit the day right on the nose. Like I could give you lots of other examples, but I don't want to go on about myself. Anyway, the most recent round of quarterly earnings reports helped to sort companies into two camps. McDonald's, Starbucks, and Home Depot were among the consumer-centric companies that surprised investors with weaker than expected results, saying customers had pulled back on their spending. Others, like Sweetgreen, Delta Airlines, bucked the trend and reported growth. The takeaway, consumers have become more selective about how and where they spend their dollars. Consumers continue to be even more discriminating with every dollar they spend as they faced elevated prices in their day-to-day spending. McDonald's CEO Chris, no way I'm going to do that last name, Chris K, said on the company's conference call in late April. Big box giant Walmart said last Thursday shoppers are prioritizing buying food and health-related items over general merchandise like home goods and electronics. Well, I certainly hope so. The retailer has reported that trend for several quarters now, according to finance chief John David Rainey. He told CNBC that Walmart's grocery business has gotten a boost from the widening gap between restaurant prices and the cost of cooking at home. Lower income consumers are struggling more than other demographics. That would always be true, but it's more true now. They couldn't save as much during the pandemic, and evidence suggests they have exhausted whatever savings they pulled together. On top of that, rent prices have surged, and low-income consumers are more likely to rent than to own. The markets also seem to have really settled. Oh, that was the end of the story. So what we're talking about here is, of course, is the consumers running out of cash, the consumers running out of buying power. And when that happens, the game is over. And it's not going to happen. It's not going to happen like a whimper. They're all going to run out at once because this kind of spending is kind of, humans kind of operate the same way. And that's why you're hearing these companies talk about these trending patterns. Rich old folks, they're still traveling like crazy, but they're not necessarily spending as much money out at restaurants right now. Young couples not spending money at restaurants at all, especially even fast food, and eating more at home. All these things it's gonna spiral. You'll see. I think I'm still only 30-60, remember. 30%, we have a recession. If we have a recession, it'll be because the consumer runs out of money. Now, there is kind of an interesting thing happening in the markets right now, which I just really kind of started to feel this over the weekend and then saw today a couple of articles confirming it. The markets have settled. They've settled. They're settling on a way forward. We've reached these all-time highs in the stock market. And now the VIX, which is a measure of volatility, which also tends to let you know how comfortable traders feel. Are they risk averse? Are they risk perverse? Are they filled with fear? Are they filled with greed? When the VIX is down, like it is right now, under 12, that indicates that people are kind of calm and feeling good about things. And I think that's because, and a number of articles today were saying this, is the market believes there's no chance the Fed is going to raise this year, and the Fed presidents and various people have been coming out over the last week or so saying that over and over again. No, there's not a chance it's going to raise. And maybe there'll be 1 to 2 cuts, and I don't think the market cares anymore. I think they recognize that these interest rate levels are not that crazy high, and that by and large, people are getting used to these what do you want to call it? The charges that the interest rates, they're getting used to the interest rates. So that's kind of where I see it right now. We'll see what happens over the next few days, but right now there seems to be a calm out there, and that's how I'm calling it anyway. All right, so let's take a look at how things turned out today. We know, of course, that Tesla was down today, $2.51, up 0.09 in the after hours. Of course, the Dow was down 200 points. That seemed to be because people did not like the fact that Jamie Dimon says, hey, his retirement is coming soon. And that really dropped Goldman Sachs value, and that seemed to hit the Dow pretty big. Because the NASDAQ was up 108, but that was almost always all 100% on the back of course, NVIDIA, who comes out with their earnings on Wednesday. That seems to be what's driving that. Standard & Poor's up $4.86. So I'm sorry, 4.86, not dollars. I do that sometimes. So that was more kind of the combination of the two. You got the S&P going nowhere. All right, so let's jump in now. Oh, the Magnificent Seven altogether, as it was this morning, it was kind of mixed. Meta down, Amazon down, but Apple, Google, Microsoft, and NVIDIA up 23 points. By the way, I do think there's been some amount of money coming out of Tesla going into NVIDIA in particular, but maybe also into Microsoft. Microsoft's now the largest company in the world. Apple seems to be getting a little bit of a bounce right now. Some money might be going into Apple out of Tesla. Many, many, many Tesla stockholders are old Apple stockholders that made big money on Apple and have moved into Tesla. Some of those might be seeing an opportunity moving back into Apple. All right, that's no investment advice in there at all, because that's not what I'm doing. I'm 100%, whatever I'm doing right now, it's all about Tesla. All right, let's go ahead and take a look at the bonds. We have got the bonds in the aftermarket. I'm sorry, in the pre-market. How come I'm not showing the, oh, here we go. Oh, we did this. Oh, my goodness. I'm so sorry. Take me a second here to get back on pace. Come over to bonds again. See all. Okay, here we go. Everything's good. Hit four, up 0.6 of a basis point in the pre-market. 2-year up 0.9 of a basis point, and the 2-month up 0.3 of a basis point. So not much change right now in the pre-market there. Let's go on to oil. Oil is down 15 cents, 79.65, back under 80. The spread between the two is still almost exactly $4. Natural gas continuing up $2.75. I'm very sorry. I promised this morning, or I said this morning, I would look into natural gas, see why it's gone up over $1 in a very short term. Did not have a chance to get that done. All right, we've got gold easing a bit down to 24.30. That seems to me still very close to it is very close to all-time highs. We got silver backing off a little bit too, but not copper. Copper is now at $5.11, going up again in the after hours. I told you about this first. You had no idea about this. I'm sorry, Larry, but even Larry did not predict that copper was going to go crazy. And it was obvious because we need all this electric infrastructure build out, and they need a lot of copper to do that. So you heard it here first. All right, let's go on to the dollar is flat. And the Bitcoin jumped up 5,000 points to 71,267. No idea why. I don't follow it. Just reporting to let you know. And then in terms of the equities, you've got all three down a bit, but just a tiny bit. The Dow down 20 or 0.05%, S&P, call it flat, and Nasdaq's down 13 or 0.07%. All right, so that's where we are as we go into Tuesday. Remember, there's no national reporting tomorrow either. No special reports about how the economy is going tomorrow, but we will be here bright and early tomorrow morning to bring you whatever knowledge we have been able to amass over the next 12 hours or so. 12, 13 hours. Then the key thing is you want to go listen to Brian White's video. We did it just a little while ago. In that video, we went around the country, around the world. We looked at very specific issues, and especially in Germany and in Europe, where Brian is right now. So you want to see that one. The card will be right here. Brian will be back tomorrow, of course, on Tuesday. And the regular crowd will start showing up all week with Cern and Jeff and I can't keep track of all these names anymore because I'm old. All right, that's it. I think I should just sign off before I say something dumb. Could happen. It's been great talking to you.